Welcome, everyone. This is Pinnacle Professional College, and today we will be discussing management accounting. We'll be focusing on target costing. As I promised, I'll be bringing you, worked examples of different issues when it comes to costing, right? Right now, what I want to do is lay the theoretical foundations of things around activity-based costing, which we covered in our previous lecture, as well as target costing and all other issues in between. So let's begin. If you haven't subscribed to the channel, please do so and hit the notification bell. So target costing simply means setting a target cost for a product, having identified a target selling price and a required profit margin, right? So with target costing, right, it's a reverse form of pricing where a producer or a seller of a product, let me put it out, a seller of a product will determine the price of the product first, right? And determine the profit that they're supposed to make or they want to make, and then create a product that would align with that in terms of costs. So what do I mean here? Let's say a seller is into selling cars, or a car manufacturer, right? Let's say Toyota. If Toyota uses target costing, what they will do is they will determine the price of the Toyota car, right? Let's say then they determine the price to be 10,000, right? And let's say they want to make a required profit margin of, let's say, $3,000. So 10,000 is the price they want to sell at. $3,000 is their required profit margin. And then what will be their costs? Their cost will therefore be 7,000. So what they do is that they design the product in such a way that it will only take 7,000 to produce it, $7,000 to produce it, basically. So they set the selling price first, set the profit margin, and then structure the product in such a way that it's able to meet the cost criteria that they've set. Usually what you would see is that people produce a product and the product will cost something. Then after they put a profit margin on top of that, and then the profit margin plus the costs would be the price at which they sell. Target costing is the opposite. They set the selling price, they determine the profit margin, and then from there, they have a target cost, which simply means the cost bracket within which the product must be produced, the cost brackets within which the product must be produced. So here we say it involves setting target costs for a product, having identified, number one, a target selling price and a required profit margin. It involves the design, production, and selling a product at a cost that delivers the required profit at the target selling price, right? So you are able to, with target costing, you're able to deliver a product at a cost that is able to generate the profit that you want at the target selling price. So let's say you are producing a shoe, right? And you determine the selling price to be $10. You want to make a profit of, let's say, $3 on that. Then it means that you have your costs should be around $7. So in producing the producing the shoe or the product, you must have in mind that you must produce the shoe in such a way that it's up to $7. Otherwise, you will not be able to meet your required profit margin. So it's a very, very intricate way of managing your costs so that you can get your required profit at the targeted selling price, basically. What are the objectives of target costing? It focuses on getting the expected cost of a product down to a targeted cost amount, which we already described, right? It focuses on getting expected cost of a product down to a targeted cost amount. So let's say if you are producing a shoe in my earlier example, and your target cost is $7, then it means that you would, the materials that you use, the labor that you use, everything, you must be efficient enough so that the cost of the shoe is $7, right? You must come up with materials and labor and overheads. All of that must come to the tune of $7. So that becomes your target cost. It's a cost you work with. It's a cost you work at. Right. So what are the steps in target costing? Number one is determine the product specification of which an adequate sales volume is estimated. So you determine the product specification. So what is the product specification we are looking at here? You can't sell without a product, basically. Number two, you decide on the target selling price. I told you that this is key. Decide on the target selling price at which the firm can sell its product to achieve the required market share. Number three, then you come and estimate the required profit margin. Estimate the required profit. Very crucial. You come and estimate the required profit. And number four, you calculate the target cost. The target cost is simply your selling price less your target profit. Number five, you prepare an estimated cost for the product based on initial design specification and current cost levels. So after you have the target costs, then you can go ahead and prepare a design for the product based on the costs, right? So the design would be based on the costs. So you can prepare an estimated cost of the product based on the initial design specification and current cost levels. Number six, calculate target cost gap. Target cost gap. Now, what is the target cost gap? This is simply estimated cost less target costs. That's the target cost gap, the target cost gap. So that's also another thing you have to calculate. Now you make efforts, number seven, you make efforts to close the gap. You have to make efforts to close the gap because the target cost gap is simply the difference between your estimated costs and your target costs, right? If your estimated cost is higher than your target costs, then we have to close the gap. Because if we do not produce the product according to the target cost, we will not be able to make the required profit margin that we want. It's very key. So you have to make efforts to close the gap. This can be more successful if we design out costs prior to production, rather to control out costs after production began. So you can be more successful if we are proactive at this. If we design out costs before production, we are likely to be more successful rather than after production. Before production, if you have designed out the cost properly, then we are more likely to close the gap. We are more likely to close the gap. So let's use a typical example. I'm going through the steps again by using a typical example. So determine the product specification. So let's say we are using a car here. Let's say Ferrari, right? Let's say Ferrari. You want a Ferrari that is able to go at top speed. It's red. The tires are very solid. The engine is very solid. So that's around product specification. Then you determine the target selling price. The target selling price will be, if you have to determine the target selling price, probably, let's say, $500,000. Then what is the estimated or the required profit that we want to achieve? Let's say we want to achieve a profit of $200,000. Then we come and calculate the cost. What will be the cost? The cost will therefore be the selling price minus the target profit. So 500,000, which is the selling price for the Ferrari, minus 200,000, which is the target profit for the Ferrari. So the target cost is 300,000. Now we prepare an estimated cost for the product based on initial design. So we go out and prepare an estimated cost. Let's say our estimated cost comes to, based on our design specifications, our initial or our estimated cost comes to, let's say, 400,000. 400,000, right? 400,000, which is the estimated cost, is higher than the target cost, which was 300,000, right? So we have to calculate the target cost gap. The target cost gap is the estimated cost minus the target cost. The estimated cost is 400,000. The target cost is 300,000. So we have a target cost gap of 100,000. And so we have to come and make efforts to close the gap, right? And we can do this through assessing and reassessing the initial design specifications. And if we do this prior to production, we are likely to become more successful, right? Are likely to become more successful. So let's take a simple example. As I said, I'm just laying the theoretical foundation. So I won't do any hardcore examples. We will do that as we go along. So Mercedes-Benz Limited wants to calculate the target cost for a new E-Class model it wants to introduce into the African markets, the price of which would be set at 21,950 Ghana cedis. The company requires 8% profit margin on sales. What is the target cost of the car? Now, looking at this, if you are given an 8% profit margin, if you multiply the 8% by the 21,950, you should get the profit margin. If you get a profit margin, then you can deduct that from the selling price. So the solution would simply be, the selling price is 21,950. 8% of that is 1,756, 1756, right? 1756. If we deduct 21,950 from, if we deduct 1,756 from the selling price, which is 21,950, you get a target cost of 20,194. Very simple computation. Very simple computation. So let's lay more of the groundwork when it comes to target costing. Target costing. Now let's talk about closing the target cost gap. Closing the target cost gap. You can close the target cost gap by increasing the number of units that you produce. That's a way of closing the target cost gap. Another way you can close the target cost gap is by using highly skilled labor force. You know, if you use highly skilled labor force, it will likely lead to efficiencies. Another way of closing the target cost gap is by using standard components wherever possible. You can use standard components. So if you want to close the target cost gap, you need to look at your inputs, your design, your resources. That's what you look at. So you look at your materials, you look at your labor, you look at your systems, you look at your technology, right? So for instance, I told you number 2, use highly skilled labor force, right? Labor force, that's a resource, that's an input. So if you use highly skilled labor force, it's likely to lead to efficiencies. If you use standard components, that's also likely to lead to efficiencies. Acquire new, more efficient technology. That can also lead to efficiencies. If you train staff as well, you know, they are able to do the work better. And that also helps to close the target cost gap. If you use different materials, that could also be an option. If you look at the materials you are using and you change them or you modify them, that could also help reduce or close the target cost gap. Note, the most effective time to eliminate unnecessary costs and reduce the expected costs to target cost level is during product design and development phase, not after the product has been introduced into the market. It's very, very important. The most effective time to eliminate unnecessary costs and reduce the expected cost to target cost level is during product design and development phases, not after the product has been introduced into the market. So during the product design development, that's when you can reduce costs. If the product has already been introduced to the market, it's difficult. It becomes more difficult because you have to recall the product, you have to rework the product, and that increases the cost. Now let's look at target costing in the service-based industry, target costing in the service industry. Unlike manufacturing companies where the cost of the product can be ascertained easily due to information flow, in the service industry where there are a lot of intangibles, right? In the service industry, to determine the target cost of a service, it is very cumbersome because of the intangibility and inseparability or homogeneity of the service, right? So some features of the service industry is it's intangible. Like if you go to a bank to, let's say, perform a transaction, right? It's quite intangible. It's intangible. If you go to the barber shop to get a haircut, it's an intangible service. It's intangible. It's intangible. Even though the outcome can be seen in terms of a haircut, the process of offering that service is intangible. The process of offering that service is intangible. Now, we are told here to discuss the statements, right? So target costing is difficult to use in service industries due to the characteristics and information requirements of service businesses, such as intangibility and homogeneity. Because of the intangible nature of the service industry, it's quite difficult to use target costing. So we would discuss some of the features of the service industry so that you can understand exactly what we mean. So features of the service industry, number one, or features of services. Number one is intangibility. It lacks physical existence. It lacks physical existence, right? So what do we mean by this? It's not something you can physically touch. A service is not something you can physically touch. Number two, inseparability. It means that it's a joint service. It's a joint service. What do we mean by joint service? So for example, when you go to a barber to get a haircut, you cannot separate the barber from the barbering. You cannot separate the barber who is offering the service from the service itself, which is barbering. So you cannot separate the provider of the service from the service. It's inseparable. It's inseparable. It's inseparable. Very, very key. Very, very key. The third thing is heterogeneity or variability. Heterogeneity or heterogeneity or variability, right? When it comes to services, right, there's a lot of variability or heterogeneity, right? There's a lot of that. There's a lot of that. So for example, when you go to a barber to get a haircut and you see a number of people there, right? If all the people tell the barber they want a specific haircut, you would realize that after the service is offered, the haircuts are not exactly the same. So many services are heterogeneous, which means that they are typically modified for each consumer or situation. So what does this mean? It means that the taxi service that transports the consumer from his home to the cinema is different from the taxi service that transports the same consumer from the, from the cinema to his home, right? It's the same consumer here, same individual, but the service varies. The service varies for each consumer or each situation. It's very, very important. Very, very important. That's why in a barber shop or in a hairdressing salon, you see that variability. Somebody would, the same hairstyle, but you see that it doesn't look exactly the same on different people because of that variability, because of the human factor. Number 4, perishability. Perishability. Services can easily be outdated. Number 5, non or limited transferability of ownership. Non or limited transferability of ownership. Very, very important. Very, very important. So what does this mean? What does this mean? It's sometimes difficult to transfer ownership of a service. That's why when you go to a barber shop, and there'll usually be, a lead barber or a barber who is very experienced and the apprentice, right? Sometimes you would not want to cut your hair with the apprentice because of that. Sometimes limited transferability of ownership. It's very, very important. Very, very important. So these are the 5 characteristics of services. 5 characteristics of services. It's very, very crucial. Very, very crucial. Please master these characteristics. So in explaining number 5, another thing I need to add is that non-transferability of ownership, right? Another thing I need to add here is that you cannot own and store a service. You cannot own and store a service. You cannot store a service. A service is not like a product where you can buy a bar of chocolates and store it. You cannot own and store a service. You can own and store products, but not services. Because it's linked to the intangibility, perishability, inseparability of services, right? It's very, very important. So you cannot own or store a service. Now let's talk about lifecycle costing. Let's talk about lifecycle costing. For those studying strategy, you might have heard of this. It estimates the cost and revenues attributable to a product over its entire expected life cycle. The life cycle cost of a product is all costs attributable to the product over its entire life, from the product concept and design to eventual withdrawal from the market. So every product goes through a life cycle. Every single product goes through a life cycle. So what life cycle costing does is it estimates the cost of the product from the time the product is conceived and designed to the time it's even withdrawn from the market. So it's estimating the cost of the product over its entire life. Over its entire life. Now, what's the purpose of life cycle costing? Is to assess the total cost of a product over its entire life. Also, to assess the expected profitability from the product over its full life. Right, so that's the purpose of life cycle costing. Now let's look at the stages of life cycle costing. If you understand the product life cycle, you can easily relate it to life cycle costing. Stages of the life cycle costing. Number one, development stage. Number one, development stage. This stage accumulates costs regarding the design and feasibility of the product. Example, research and development costs. Here, the product is yet to be introduced into the market. So the development stage, a product will go through a development stage where, we try to assess the feasibility of the product, how the product is going to be designed, etc. Then from the development stage, the product goes to an introduction stage. And this stage accumulates costs regarding creating awareness about the existence of the product. Right? When you introduce a product to the market, few people will know about it. So what's the natural thing to do? Is to make noise, make people aware, put the product in front of customers. So that's the introductory phase of life cycle costing, because the demand for the product is low at the introduction phase. So you need to create awareness about the product. Then you have the growth stage, what we call the growth stage. Here, the product gains a bigger market share as demand increases. Sales revenue also increases and the product begins to make more profits. So the work you would have done in the introduction phase by creating awareness will begin to, materialize in the growth stage, and you'd see that people begin to get aware of the product. Demand will increase, sales will increase, and therefore profits will begin to come in. You have the maturity phase. This is the most profitable stage of the product life cycle. But the growth in demand begins to slow down. Sales would have reached its peak here in the maturity phase. So in the maturity phase, it's the most profitable, but you see that growth will begin to slow down. Then you have the decline. You have the decline phase. Here, the products would have reached its saturation. The products will reach its saturation, demand will begin to fall, and the product will eventually make losses. And, the manufacturer or the producer will have to withdraw the product from the market. For some other companies, when they get to the maturation or maturity stage, they're able to reinvent the product and represent it to the market. And so they do not necessarily go to the decline stage. Because at the decline stage, the product begins to make a loss and demand falls, and the product will have to be withdrawn from the market. Now, question, right? Show by means of a diagram the life cycle of a product, showing the trend in sales and profits and stating two benefits. So this is a question that you can attempt based on the discussion we've had on the different stages of the life cycle of a product. You have the development stage, we have the introduction stage, you have the growth, maturity, and the decline stage. And we talked about revenue and sales and demand for all of these stages. Now, what are the elements of a product cost? Number one is research and development. Number two, cost of purchasing data. Number three, training costs, production costs, distribution costs, marketing costs, inventory costs, retirement and disposal costs. All these things are examples of product cost or elements of product cost. Now, before we end our discussion today, let's look at some of the benefits of life cycle costing. What are the benefits of life cycle costing? Now, life cycle costing helps us to assess the profitability of a product. It helps us to assess the profitability of a product. It also helps us to estimate sales volumes and prices for products, because we understand that product goes through different stages, and these stages would influence the sales volumes and the revenues at the different stages. Number three, it also helps us to promote actions to generate more revenue. So depending on the stage of the life cycle that we are in, we are able to engage in promotional techniques to create awareness about the product, which eventually helps to generate more revenue. Number four is it also helps us to achieve an accurate assessment of revenues and costs. Very important. Number 5, it enhances better decisions for the product. You can make better decisions by understanding the stage that the product is in the life cycle. Life cycle costing also helps to encourage long-term thinking and planning. Long-term thinking and planning. Number 7, it also gives useful information. You know, if you are looking at the product within the context of its stage in the life cycle, then it gives you more information, more understanding, more background to the product. And that helps you to make better decisions surrounding the product. The better the information, the better the decisions. So this is where we would bring today's lecture to. Thank you for watching. If you haven't already subscribed, please do so. Hit the notification bell and see you in the next lecture. Have a good day. Bye.